All right, good afternoon, gang. John King with Summit Funding. Thank you for joining me for my weekly market webinar. If you're joining me on Zoom, feel free to post questions at any point in time on the chat in Zoom. If you are joining me on Facebook, I'll be broadcasting this live on Facebook. And if you have questions, please feel free to post them there, and I'll be checking that a little less frequently than I'll check Zoom. But anyway, let's go ahead and get started with today's update. So first and foremost, gosh, we are absolutely tearing up this year. We're halfway through the year already, almost halfway through the month of July. A lot of craziness going on and changes continuing to happen. And so I'll dive in and cover all of that with you. So today what I want to talk about is a rate update, as I always talk about where interest rates are, where we kind of see them going. We're going to talk about an update on the forbearance market and what's happening there. I'm going to give you a jumbo update. We're going to talk about the jumbo market and what's happening there. And then we're going to do a cost of waiting and kind of cover what it means if you wait on buying a home until prices drop and kind of what that's going to cost you. I had a presentation or a summary to show you on kind of what it looks like if you pay over appraised value, but those numbers, that system did not cooperate with me right before this presentation as I was trying to pull it up. So we're going to skip that part and I'll cover that for you next week. But today you'll get an idea of cost of waiting and kind of put some numbers behind that so that you or anybody that you know that's thinking about buying a house but want to wait until prices drop, get a feel for what it's really going to cost you. So first and foremost, interest rates. As I've told you guys all along, interest rates up is good on this chart because up is the value of the mortgages when we sell them onto the marketplace, and the higher the value, the lower the rate is that we have to charge. As you notice, the value has been going up and up and up, and over the last couple of days, it's come down some. There's a couple of reasons why that's happened, and it really isn't a bad thing. In part, it's happening because there's a monthly event called the rollover. And very simply, what the rollover says is when we close a loan right now, we're packaging them up and selling them based upon when the first month the investor's going to start earning interest. And so loans that have closed right now, they're going to, or prior to now, are going to start earning interest on August 1st. But basically, every loan that is going to start earning interest on August 1st is already funded. And so the investor, when they're buying pools of mortgages, they're saying, hey, we're buying them based on the month we're going to be beginning earning interest. And when we lock, that's kind of part of what we're doing is we're buying into a pool that the investor knows they're not going to start earning interest for a few months down the road. And they want to get a higher rate or a higher fee for the fact that they're not going to start earning interest for a few months. And therefore, the value of the rates are higher, and the value of that coupon, or the value of that loan, is lower when it's earning interest starting a month later. Well, at a certain point, we got to close out the books, and we got to say, hey, the loans that start earning interest on August 1st, those don't count anymore. Now we've got to peg our market rate to the value of loans that are earning interest on September 1st. That causes a minor drop because we're comparing the numbers to what the rates were for loans that started earning interest in August. And clearly, if they have to wait one more month, the loan is less valuable. Complicated explanation to say this minor drop wasn't that big of a deal. A little bit of it had to do with the stock market taking off on Friday afternoon, but a lot of it had to do with what we call the rollover. My advice is still the same, which is we're going to see peaks and valleys like this. That's why when you're purchasing a home, you should lock as soon as possible. But when you're refinancing, wait it out, because if you get closer, if you're buying into a bond where the mortgages get earning interest sooner, the cost is lower, you get a better interest rate. So if you're refinancing, let's start the loan process. Don't lock it in until you get final approval, and that way you get the best possible interest rates. So let's talk a little bit about what's happening with the stock market and with the bond market. So really what's happening here, these are the movements of the 10-year Treasury versus the S&P 500. And what you're seeing is the stock market has gone up and up and up, and we've seen major increases in stock prices over the last few months, basically since March, that we've seen pretty significant increases in stock prices. And so that's representing here stock prices going up, and they start coming back down, up and down. But what you notice is the ups and the downs, the pattern is getting tighter. It's called consolidation, and there's typically a breakthrough up or a breakthrough down in the consolidation. The same thing kind of happened with mortgage rates. We started seeing in April a little bit of the up and downs, kind of moved stuff up a little bit, not for mortgages, I should say, but for the 10-year Treasury. So the 10-year Treasury has been getting higher, and then we hit its peak right here in the beginning of June, and it shot, and that was right when the jobs report came out at the beginning of June, and everybody thought, oh my gosh, the job problems have been solved. We have no problems anymore, so we should be able to, recover the economy super, super quick. Fast forward a month and a half, and we know that's not the truth. So what's happening is that bond rates for treasuries have started coming down. And so we see a breakout. What happened on Friday? Stocks moved up a lot, but the bond market is still within its range. But here's what people don't fully understand. And I've been working on explaining this to you guys over the last few months. The mortgage market still has room to drop. So if we go back to 2018, in the fourth quarter of 2018, you can see a very, very tight correlation between the blue line, which is a 10-year Treasury, and the orange line that's mortgage rates. Very, very tightly correlated. A little bit of a break in early 2019, but overall very, very tightly correlated. And then we end up here in the early part of 2020. Huge drop in Treasury rates, significant increase in mortgage rates. This is what I've been talking about by saying, guys, the rates should be a lot cheaper than where they are today. Now, what you see is even when the 10-year Treasury is coming up, mortgage rates are coming back down and they're getting closer. The distance between the Treasury and the mortgage rates is shrinking. That's a good thing. That means that when the 10-year Treasury goes up, we can still see mortgage rates come down. That's the room that we have that I think we see a good indicator of interest rates continuing to go down over the next few months, and we will see mortgages continue to get pressure from the Fed to get cheaper because the Fed is buying a huge amount of mortgages and they're trying to push these rates lower. So I see a lot of room for interest rates to continue dropping. And I think this chart really outlines that pretty clearly, how much room we really have for rates to keep going down. All right, so a forbearance update. So last week we saw the biggest drop in forbearances yet, and we're back to April levels. So this is huge. This is really, really good news. Now, part of it is because we're 3 months into what for most people was a 3-month forbearance timeframe, and therefore it ended automatically and they did not ask to renew it. So forbearances were down as of July 7th to 4.14 million, which is a little less than 8% of all mortgage loans. A disproportionate amount continues to be on FHA and VA loans. But guys, here's our upcoming concerns. First and foremost, the second wave of shutdowns. If you haven't read the news today, the state of California is undergoing a much greater level of business shutdown than what we had over the last couple of weeks with just restaurants closing now. And I haven't read the whole article, but basically a lot more businesses are being required to shut down again. I don't know what we want to call it, a soft shutdown, a softer shutdown. I don't know. All I'll tell you is history, what was that saying I said a couple of weeks ago? History doesn't always repeat itself, but it often tends to rhyme. So what we're going to see, do we expect everything to repeat the way that it's going? I don't know. But is it going to rhyme? Is it going to sound similar? Yeah, there's a really good chance that's going to happen. California was the first to close back in March. So if you think back to the pattern that we had, California closed first, other states started closing after that. We see California significantly increasing in the COVID numbers. This is not a political statement by any means, it's just a fact. And the fact is that the state is pulling back, and that is going to impact the economy, that is going to impact the markets, and that is good news for mortgage rates. The concern is what's it going to do to the jobs market? You've heard me say over and over again, the impact to jobs when it comes to COVID shutdown is really on the low end of the socioeconomic scale. The frontline workers that are in service work positions such as restaurants, hotels, et cetera, those are the ones that are being harmed the most. They're not the typical person buying a home right now. So do I expect this to significantly hurt the housing market? No. Am I concerned that maybe if we keep having issues with case counts going up in California, will we start having more issues with showing homes and getting people out to homes and being able to sell homes like we did in March and April? That's a serious concern that I've got as we look to go forward. That's something we've got to pay attention to. And this has to do with the forbearances because people are losing their jobs again. And that's going to impact their numbers on how many people need to go into forbearance. The other thing I'll tell you, and I've reminded you of this a couple of times, is PPP money. So the PPP is the Paycheck Protection Program. And that is the program that SBA came out with that said, we will pay for your employees for a certain period of time using this money. And if you use it for your employees, then we will forgive the loan. Well, at a certain point, that money runs out. So an employer who says, hey, I got all this money, and if I send a portion of it on my employee salaries, then I'll get the rest of it. I'll get the whole thing for free. Well, then they're happy to pay salaries for people that they don't have work for that person to be doing. And so my concern right now is as the PPP funds start running out, not running out, let me rephrase that, as the employer uses up the allocation of PPP funds that they had brought in, they're going to say, well, I can't afford to keep this person on staff anymore because I don't have the work for them and I don't have the money coming from the government as an incentive to keep them employed. That is going to likely push up unemployment numbers, and that is going to potentially push up forbearance figures for these people who are not able to make their monthly mortgage payment. And guys, just as a big picture reminder, this is really significantly impacting credit availability because the mortgage industry is fearful of all of this stuff. And I'll give you a couple of examples of that. So the Mortgage Credit Availability Index comes out every quarter. And we just got the numbers for the first quarter, or excuse me, for the second quarter that were officially as of June 1st. And the second quarter numbers are continuing to show mortgage credit availability dropping. Now, it didn't drop as quickly as it did in the first quarter, like it literally plummeted, but it was still a pretty significant drop in the second quarter as we continued to see mortgage programs cut back and it become a little bit harder to qualify for mortgages. And we're going to continue to see that as we have a lot of uncertainty in the market. Here's a couple of examples, and I don't expect you to be able to read all of this, but conventional loans. So those are loans that are backed by Fannie Mae and Freddie Mac. This is the drop that we saw, and again, a pretty significant drop in credit availability for Fannie Mae and Freddie Mac loans. Below that's conforming loans. You say, John, what's the difference between conventional and conforming? Conforming is the size of the loan. So if it is under a $510,000 loan, it's considered conforming regardless of who the investor is. Conventional means it's backed by Fannie Mae and Freddie Mac. And so you saw a much bigger drop in the Fannie Mae, Freddie Mac world than you did not see as big of a drop across the board on conforming loan limits. A big part of that is because high balance loans, a lot of lenders pulled out of that category or curtailed significantly what they would do in high balance for the same reasons that we saw a pretty significant pullback in jumbo. And that's the biggest drop you see right here. Jumbo loans had the largest drop in mortgage credit availability, and it continues to drop. Government loans, those are backed by Fannie Mae, those are backed by FHA and VA, not that big of a drop on those loans. So we're seeing the biggest drop in jumbo loans and then the second biggest drop in conventional loans. So what does that mean? Well, a couple of things that it means. First of all, some updates on jumbo specifically over the weekend. I think it was Friday. Wells Fargo came out with an announcement. And I don't know if this is a policy yet or this is just a proposed announcement, but it was clear that this is something they're bringing down the pipe. And I'll give you some color behind it. Back in May, Wells Fargo changed their guidelines to say to do a jumbo loan with us, you have to have $250,000 on deposit with the bank. And now Wells Fargo is going to change their guideline, and they're going to change it so that they're requiring $1 million on deposit with the bank in order to do a jumbo loan with them. That is obviously their goal to limit their exposure. If you got $1 million in the bank, then the chances of you defaulting on that mortgage are pretty slim. And the $1 million is deposited with them. So they're making the money off of it that would offset whatever potential losses they're going to have. They're very clearly saying, I only want to do jumbo loans for those people that are my clients and my top tier clients. This sounds a lot like what happened with the PPP loan a few months ago. And if you at all tried to get a PPP loan, you probably ran into this same thing with your bank. Banks did not want to do the PPP loan through SBA unless you were a client of theirs. And so a lot of people said, well, I want to do a loan, and where do I go? And they would call a bank and they'd say, I'm sorry, you don't bank with us. And then they'd call the bank they do bank with, a big bank, and the big bank would say, I'm sorry, we're too busy because we're working with all of our big clients, all the clients that have significant amounts of money with us. Those are the ones we're taking care of first. That's the haves and the have-nots, unfortunately, and that's what we're seeing in the jumbo world, is a lot of the retail banks that owned that corner of the market they're starting to pull back and they're starting to say, you know what, I only want to do it for the people I have to do it for. And the people I have to do it for are the ones that bank with me. I don't want them to take their money away. And we've got a great relationship. So just be aware, a lot of rule changes in the jumbo world. As a reminder, we have jumbo products now in-house. I'm doing a $1.2 million purchase in San Jose right now, and we got the contract on Friday. I'll have the appraisal back this Friday. I'll have approval by day 14, and we'll be able to close in 21 days. So very, very well prepared clients. We got the file ready and set up perfectly, and it'll be a great transaction. So we're definitely in the jumbo market. Rates are super competitive. Here's the general rule, though. Reserves are our biggest issue. 20% down is required, and you've got to have a significant amount of money in reserves. Anywhere from 6 to 18 months in reserves, and often anywhere from 3 to 12 months of those reserves have to be non-retirement funds. So that means that somebody's got to have a pretty sizable amount of money. If they have a $5,000 monthly payment, PITI, principal, interest, taxes, and insurance, then 6 months is $30,000. A year and a half is $90,000 of reserves that they have to have. And again, a portion of that needs to be non-retirement funds. Overall, everything else is pretty reasonable. So when you think about the jumbo market and the guidelines on jumbo loans, at least for the products that we have, it's very, very reasonable. Nothing is really outside of the box, with the exception of reserves are huge. And debt to income ratio, for the most part, needs to stay under 43% debt to income ratio, although I do have one lender that'll go all the way up to 50% debt to income ratio. The rates are higher for it, but we definitely have the ability to do that if you have somebody that needs it. Second mortgages are hard to come by, gang. We're finding fewer and fewer institutional investors willing to do second mortgages behind first mortgages for a purchase transaction, what we call a concurrent closing. We're having a really hard time getting investors that will do that. And so you've just got to be aware that getting a first second combo to avoid a jumbo loan or to avoid mortgage insurance is super, super difficult in today's market. So just be aware of that fact and be prepared to put a small down payment and pay mortgage insurance. Be prepared to go with the jumbo loan. Just be aware, or be prepared for a very long escrow. Because the one bank we have that we trust that does them very, very well, they're taking 60 days to do a loan. So that means we've got to have a super long escrow, and for most people that just isn't a reasonable option, especially in light of today's super hot market. We've got to be careful about buyers thinking that, hey, I can get into a 60-day escrow, no big deal, and you're out wasting your time writing offers and never getting anything accepted, because who's going to accept a 60-day escrow in today's market? So that's my concern there. The final thing I want to talk about today is the cost of waiting. Now, I have this as a web page, and I can email it to you if you want, and you can share it with your clients. But I want to go over kind of a really, really big picture of some numbers to help you understand what is the cost of waiting if you are thinking about purchasing a home and you decide, you know what, I'm just going to wait until next year because my buddy says that prices, Susie Orman says that prices are going to drop. Anybody see that? Yeah. So Susie Orman says prices are going to drop and I shouldn't buy a house until prices drop. First of all, prices aren't going to drop anywhere near Susie Orman. It says they're going to drop, and I don't think they're going to drop very much, if any, because we have a lot of pressure on housing prices to go up. I think the biggest factor, as I've told you before, is generational. We have that 30-something generation that if you're not marketing to it right now, you need to market to the 30-somethings because they do not own a home. 10 years ago, they graduated college and they decided they didn't want to do any adulting, so they moved back home with mom and dad, and now they're in their 30s, they're thinking about getting married and having a kid, and deciding that living at mom and dad's is probably cramping their style to find a spouse and have a kid and get married. So they're buying houses, and they're going to drive this market, in my opinion, for the next 4 or 5 years, and they're going to be the power behind the housing prices continuing to sustain, if not go higher, in the long run. So as we look at that, what we're really seeing is a ballpark idea of last year's interest rates. We were up at 4.5% last year. And so I'm just kind of taking a, hey, if you bought a house at $400,000 last year and you put 10% down, you're at a 4.5% interest rate last year. Your payment is $24.77 a month. Fast forward to today. So we're buying the same house today for $410,000. We're putting the same 10% down payment, but rates have dropped significantly. We're at a 2.99% interest rate. So that puts us at a payment of $22.23 a month, or $254 in savings. Guys, I just caught that there was a glitch. It doubled the closing costs on this one, so that is inaccurate on cash to close. But the cash to close should be pretty similar. There's no difference. It's the same 10% down. So ignore the cash to close piece. The payment is what I'm talking about. So you're saving $254 on your monthly payments by the fact that the housing rates, or the interest rates, have dropped to 2.99, even though housing prices went up by $10,000. Huge monthly payment savings, because interest rate is what matters, not housing prices. And you see that huge drop, even though prices theoretically went up in this example from last year to this year, your payment went down by $254. But people who are waiting for prices to drop back down, and they say, oh my gosh, they're going to go back down to where they were last year or even lower. Okay, well, let's pretend we have a $30,000 price drop. Okay, so that's about a 7.5% drop in a year. That's a pretty sizable drop, and I would not expect that big of a price drop. But let's just pretend that prices drop by that much. So we had a drop from 410 today to 380. That's a deal. We should buy the house because you saved $30,000 on the price of the home. But you didn't, because although your down payment went down a little bit because you're putting 10% down on $30,000 less, so it saves you approximately $3,000 out of pocket. But aside from that, your payment is a little bit higher. You are paying more per month, because if prices drop and the market shifts in such a way that prices drop, then it's likely interest rates are going back up. And I didn't even make them go up as high as the 4.5 they were a year ago. I just went from today's average of 2.99 up to a 3.99 interest rates. And a lot of people would think, well, that's no big deal. The rate went up by 1%, because I saved 7.5% off the purchase price of the home, and I saved $30,000 up front. And you didn't. You actually cost yourself, you save $3,000 up front, but you cost yourself $30 a month over the next 360 months. So we're talking about what? 30 times 360 is $10,800 of additional payments, and you had to spend the extra $30 a month. So waiting for prices to drop is not a good strategy. And if you have somebody who's thinking that's the right strategy, have them give me a call. I can go through this with them and explain to them the numbers and say, how much do you think prices are going to drop? Let's ballpark where interest rates are going to go. And how much money are you throwing away right now by waiting? Because you're throwing away the tax write-off. You're throwing away the appreciation that you'd be gaining if you're wrong and prices do go up. And you are throwing away the principal pay down, because currently you are paying off somebody else's mortgage by making their payment as their tenant. And instead, you can put that money in your own pocket as equity pay down on your mortgage. I hope this helps give you some very specific numbers, because I'm hearing that from clients periodically that, hey, I think I want to wait and not buy a house because I think prices are going to drop. And again, to recap, even if prices in this case dropped by $30,000, but rates went up by 1%, because if the dynamics happen that prices do end up dropping, then I expect rates to climb back up close to, if not at, where they were last year. Remember, that was at 4.5. So it is not saving you any money by waiting. Now is an amazing time to buy a home. And if you have any questions about that, send your clients to me. I'd be happy, or send yourself to me, and I'd be happy to help explain that to you. Aside from that, gang, that's all I've got for today. As I've told you guys over the last few weeks, I'm going to do this only on Mondays. I'm shortening it because I want to make sure I'm covering only the new information that matters. So hopefully you find this beneficial. If you know anybody who needs great advice, I would love the opportunity to help them out. And please feel free to share this with anybody else you know who could use similar information, or invite any of your realtor peers to join me on upcoming calls. Thanks, gang. Have an amazing day, and we'll talk to you later.